Good morning, ladies and gentlemen, and welcome to Day 2 of Oil and Money 2016. My name is Peter Kemp. I'm the London Editorial Director of Energy Intelligence, and I'll be your host through the day today. And really, that only leaves it to me at this juncture to pass over to the moderator for our first panel to introduce the Petroleum Executive of the Year, over to Alex Schindelar, the London News Editor of Energy Intelligence.
Good morning, everybody. Your Royal Highnesses, Excellencies, ladies and gentlemen, ahlan wa sahlan to our very honored guests. Welcome to the second day of Oil and Money. It's really my great pleasure to introduce His Excellency Khalid Falih, Minister of Energy, Industry and Mineral Resources, and the Chairman of Saudi Aramco. He is the winner of this year's Petroleum Executive of the Year, which is given each year to the energy industry's top executive as selected by a panel of his peers. I first came across Khalid in 2006 at an oil event in Dammam. He was the head of Aramco's industrial relations at the time. And that day, and many occasions since then, I always found him quite impressive, knowledgeable, detail-oriented. So to me, it was really no surprise that he sort of rose through the ranks very rapidly, became chief executive of Aramco in 2009, was appointed to the Saudi cabinet in 2015 as health minister, and of course this year has been appointed to energy minister back a few months ago. For those of you that were at the award dinner last night where we honored Khalid, and it was clear that his peers also had deep respect for what he has done at Saudi Aramco, and since personally, from a journalist perspective, and I think I speak for many journalists in this room, the great thing about Khalid is he takes the time to answer questions. He doesn't dodge them as much as others might do. And that's how I remembered him back in 2006. That's how he's been as energy minister so far in 2016. At both meetings that OPEC has held, both in Vienna and in Algiers last month, he took all the time to discuss, clarify, hold press conferences, and I think we really appreciate that. So I really look forward to his remarks today, which come as oil markets are passing through one of the more remarkable periods in recent memory. And with that, let me please join me in welcoming our Petroleum Executive of the Year, Khalid Falih.
Thank you, Alex, for that introduction. But I think you're setting me up for some tough questions. I read between the lines. But let me start by greeting everybody, Your Royal Highnesses, Prince Mohammed, Prince Abdulaziz, Excellency, Dalal colleagues. Last night was very special, and I want to acknowledge with humility the recognition I received on behalf of all of my colleagues and the organization and system behind what has been achieved in Saudi Arabia, and in particular in Saudi Aramco within the oil industry. This morning, however, I want to focus on the business side. My remarks will address the oil markets today and where we're going in the short term, but I will also address my perspective on long-term future of our industry before closing with brief comments on Saudi Arabia's Vision 2030. Now, as veterans of the oil industry, you will all have witnessed the boom and bust cycles that characterize our business. We're now, in my opinion, at the end of a considerable downturn, which followed a period of marked expansion. And I want to go back 3 years at a conference in 2013. In fact, it was in Houston, Sarah Week, in 2013, when the industry was enjoying the euphoria of that expansion. And I tried during my remarks that day to wave a red flag to my colleagues. And of course, everybody was conditioned at that time to think that that expansion that we had been enjoying for years was just going to last almost forever, that we were in a new normal of higher prices and great investment environment. I said on that day, and I quote, "Let me sound a note of prudent caution. This healthy picture should not make us complacent. Let's just make sure that we're collectively and individually robust enough to withstand the shocks and black swans that we know are inevitably out there. Now is the time to think about preparing ourselves for their certain arrival. If we are to position our industry for the future, we surely need to build greater resilience," unquote. And this was in the context of describing the long-term history of our cyclical business. Now, my crystal ball was, and still is, no clearer than my esteemed colleagues here in the room. But there can be no doubt that the dynamics of our industry are always synonymous with change. And today, as we convene this conference, there are many questions circulating about where the markets are heading and the role of OPEC and what it should and should not do. Let me share my view, which I trust represents the prevailing view amongst other members of OPEC. Let me go back to OPEC's objective, and this is per its statute, and it says, and I quote, "To ensure stable oil prices, secure fair returns to producing countries and investors in the oil industry." So it doesn't talk only about the member countries, but also broadly the investors in the industry, and provide a steady petroleum supply to consumers. I don't think anybody would disagree with the importance of these objectives embedded in OPEC's charter. Therefore, intervention, though, to mitigate short-term events is a rational policy with the aim of ensuring security of supply or reducing market volatility. Such as, examples of such intervention would be adding supplies to counteract the effects of production disruptions or withholding them due to temporary economic dislocations, and the emphasis on short-term and temporary. And examples are the Asian financial crisis, the financial crisis of 2008, 2009. However, when a longer-term phenomena is at play, such as the oil markets being structurally out of balance, as was the case a couple of years ago, we should, in my opinion, and in the prevailing opinion within the industry, let the market itself deal with the situation. To elaborate on this point, let me begin by briefly looking back at recent history. During the past decade, significant production from several OPEC countries left the market. This, combined with robust demand growth, helped oil prices to stay above $100 for a good period of time, from late 2010 until late 2014. These healthy prices attracted enormous investments into expensive marginal resources. That influx, alongside with technological advancements, helped the U.S. oil production to soar, reaching a peak of 12.7 million barrels per day last year. In fact, U.S. and Canadian oil production combined to increase an average of 1 million barrels per day over a 7-year period. So this was not a 1-year, 2-year, or a 3-year period. This was going to be sustained at those levels of investment pulled in by those high prices we just talked about. And this was, of course, counteracted by the withdrawals, involuntary withdrawals of production from conventional producers. However, toward the end of that period, and as expensive barrels continued to pour into the market at an increasing rate, there was no additional OPEC production involuntarily leaving. Supply-demand trajectories continued to diverge, and prices crashed in 2014. At that point, one option posed by many in the industry was for OPEC to cut production to support those elevated prices. Now, if we consider for a moment if OPEC had cut production to maintain supply-demand balances and to offset that increase in supply coming from the marginal producers, the effect would have been to encourage continued investments in expensive resources like shale, oil sands, deep sea, and the Arctic. This process would have supported the divergence I just described, with OPEC having to successfully cut production year after year after year. And I would like at this point to ask a question. If we go back before 2014 levels with the 1.2, 1.3 million barrels increases of supply and projected forward to 2017, how much additional supply would have been coming from those sources, and how much would have OPEC had to cut to make room for those supplies, which, of course, those market conditions would have also continued to crimp and lower demand to the levels we saw before 2014. And I think once you draw that picture clearly in your mind, you will come to the conclusions we come with, which is that that was unsustainable. Now, hypothetical scenarios aside, let me return to what actually transpired, where we stand today, and my views on the future direction of the market. Market forces are clearly working. After a testing period of sub-$30 prices, the fundamentals are improving and the market is clearly rebalancing due to both the supply and demand sides of the equation. And the best proof of this is looking at US inventory data over the last 6 to 7 weeks. On the supply side, rapid non-OPEC production growth has reversed into decline due to major cuts in upstream investments and the steepening of decline rates. Without investment, that trend is likely to accelerate with the passage of time, to the point that many analysts are now sounding warning bells of future supply shortfalls, and I am in that camp. Turning to the consumption side of the ledger, oil demand is expanding at a reasonably healthy rate, despite continued sluggish global economic growth. And in our view, China's oil demand is mostly evolving as opposed to slowing, as demand growth moves from manufacturing to consumption by the growing number of Chinese middle-class households, and looking at the car fleet expansion in China proves this point. And we see firsthand the Indian economy on a high expansion trajectory with large latent potential supporting continued demand growth well into the future. In fact, between 2015 and 2017, we expect to see more than 4 million barrels per day of cumulative incremental crude oil demand across the world. In addition to this, of course, we have decline rates, as I mentioned, that are steepening, and China is one area where we've seen domestic production of oil declining at a faster rate. But even though the market continues to correct, it has proven to be a slower process than many had anticipated. The reason for this is the lag time between investment decisions that were made well before the downturn and production response, which we saw into 2015. This has resulted, of course, in the extended buildup of inventories that is weighing heavily on prices today. The recent OPEC accord in Algiers was designed to further reinforce the already improving fundamentals, which I just outlined, accelerating the ongoing trend of natural rebalances and reducing the time required to achieve greater market stability. In addition, it addresses our lingering concerns about high inventories, the low present investment levels, and the lag time needed for projects to materialize and the resulting impact on supplies. as well as our worries about potential price spikes in the future. Of course, OPEC members have a significant stake in helping the market to stabilize at sustainable levels. As I noted earlier, we believe OPEC can continue to exert a positive, stabilizing influence in the market if its members act collectively. And we are playing our part as Saudi Arabia to enhance cohesion and cooperation within this important organization. I believe that the Algiers Accord signals real progress in that direction, and I'm looking forward to further productive discussions heading to our next meeting in Vienna in about 6 weeks' time. That said, non-OPEC producers account for about 60% of total global supplies, and they also have a big stake in market stability and a healthy market. Their contributions to stabilizing the market are every bit as critical as those made by OPEC members. It is therefore encouraging to see major non-OPEC producers expressing their willingness to also undertake the necessary measures to promote market stability, and we heard some strong signals in Istanbul last week during the World Energy Congress. I am extremely pleased with the current atmosphere of collaboration amongst most producers, and this heightened degree of alignment remains on the increase. So, based on the combination of improving fundamentals, rebalancing taking hold, and the joint action undertaken by OPEC and non-OPEC producers alike, I fully expect market conditions to continue improving. Let me now turn from today's headlines to tomorrow's prospects. I have no doubt that oil and gas will continue to serve as the core energy sources for many decades to come, even as the world endeavors to transition to a new global energy system. So there is a healthy future ahead for the oil industry and ample growth opportunities for individual oil enterprises represented in this conference. In my view, the industry will need to focus on 4 key imperatives, keeping in mind the long-term prospects for oil and the long cycle for projects and our decision. 1 is replacing the natural decline of maturing fields, which, as I mentioned, is not insignificant. 2, preparing to meet incremental demand, which is continuing and could grow faster as the global economy improves. 3, and significantly, as we put COP21 agreement into implementation later this year, is the industry role in playing, being part of the solution and meeting the commitments that are required by COP21. Related to that is investing in technology and innovation to reduce the industry's cost structure, deal with the challenges of complex new resources and the maturing ones that exist, while reducing the environmental footprint of oil required to meet the COP21 commitments. To meet these requirements over the next quarter century, the industry is estimated to need close to $24 trillion of capital spending alone on oil and gas, upstream and midstream projects, $24 trillion. So the financial industry must work hand in hand with us in the oil industry if these investments are to become a reality. Although prospective policy and regulatory changes impacting fossil fuels introduce additional uncertainties and insecurities into the future funding environment, which we need to mitigate. Now, ladies and gentlemen, before I conclude, let me briefly discuss Saudi Arabia's Vision 2030. This is a bold and comprehensive roadmap to a stronger, more globally competitive, and more sustainable economy for our nation. The mainstays of Vision 2030 include economic diversification, promotion of the private sector, significant localization of goods and services, including the oil and gas supply chain, comprehensive reforms across all sectors of government, and intensive capacity building and job creation. And while the Kingdom will pursue greater diversification, we will also continue to build upon the three existing pillars of our existing economy, namely oil and gas, chemicals, and mining. Indeed, we're continuing to make investments in our oil production capacity to be ready for the inevitable upturn in the cyclical business I described, in light of the important role reliable petroleum supplies play in global economic growth and stability. I would also note that the qualitative aspects of the vision, such as the development of a more vibrant and tolerant society and greater opportunities for Saudi youth and women, are also receiving special attention by this program. Most notably, though, the vision calls for taking bold initiatives to create the Saudi Arabia of the future. For example, privatization is a key element in the vision, and as you all know, the public offering of a portion of Saudi Aramco will be the largest IPO in history. Other state-owned assets and utilities, airports, seaports, and transportation will follow, helping to increase the asset portfolio of the Public Investment Fund, or PIF, to approximately $2 trillion. Those assets will be leveraged to diversify Saudi Arabia's sources of revenue through investments both in the Kingdom and abroad, and increasingly in new sectors for Saudi Arabia. And speaking of bold ideas, just this week, Saudi Arabia announced plans to jointly establish a $100 billion global technology fund with Japan's SoftBank, focusing on high-tech opportunities like the Internet of Things, artificial intelligence, and digitization. Ladies and gentlemen, let me conclude this morning by reiterating that we're seeing supply and demand fundamentals continue to improve on their own accord. This trend will be further strengthened by last month's Algiers agreement among OPEC members, as well as the prospect of cooperation by non-OPEC producers around the world. The effects of improving fundamentals and efforts by producers are already being seen in healthier market conditions, although we may continue to see some volatility going forward. Nevertheless, I expect oil markets to perform better in the coming months and into next year, and I also foresee a healthy long-term future for the oil sector. So thank you for your attention this morning, and I look forward to answering your questions.
Well, thank you, Khalid, for a long tour through oil markets, Saudi policy, OPEC, Vision 2030, Aramco IPO, and everything else. But I think we should start with the question of OPEC, something we discussed yesterday with the Secretary General of OPEC and also the Executive Director of the IEA. Of course, everybody's looking forward to what happens in November. But I noticed in your speech that you're suggesting that the market forces strategy adopted in 2014, you're not shifting away from this at this point. It seems to me what you're suggesting is it's a tweaking of the market forces strategy, not what we call return to market management, as happened in '97 with the Asian financial crisis and in 2008 general financial crisis.
Well, what I said is there is a time for everything. There was a time for decisive intervention when suddenly there was short-term anomalies that were introduced suddenly, such as the Asian crisis or the financial crisis. And on the opposite side, when you had interruptions of supply, whether it was natural or due to civil strife, OPEC and those with spare capacity like Saudi Arabia needed to intervene immediately to reduce volatility and to provide stability to the global markets. What was happening the years before 2014 was a structural divergence. Supply was increasing year on year consistently, and that's what I tried to explain, at rates that were much higher than demand increase and the natural decline that was taking place by producers. So you were building up an imbalance that basically needed to correct the underlying factor for it. And the underlying factor for it was higher prices. We don't make our decisions based on specific price targets, but it was obvious that the situation was unsustainable. Today, we're seeing that divergence close. And at the meantime, the industry has been hurt. Investors are not investing, and the industry is finding it difficult to resume growth to offset. And it's the delay, it's the time lag that I try to describe, that is the problem causing the inventory overhang, and it is today the concern that we have is that there is a time lag. If decisions are made today to invest, especially on long cycle projects, it's going to take a few years before they come into effect. In the meantime, the trajectories of supply and demand tell me that beyond working down the inventories, there will be potentially a period of shortage of supply. So we want to signal to the market by gentle action of OPEC, initially potentially a freeze or a small decline between producers within OPEC and non-OPEC working together, that we want to work down the inventory and we want investments to resume across all sectors within our industry. This is not specific to conventional and leaving unconventional behind. We believe unconventional coming in at 1 million plus, as I mentioned, was unsustainable by the market, but having them continue to decline the way they have been since 2015 is equally unhealthy. So I am happy when I see at $50 more rigs are coming back, and we think we want more rigs than what has been coming back, because ultimately we want unconventional to contribute to continued demand growth and to offset some of the declines that are taking place.
Okay, thanks. And I asked Mohammed Barkindo yesterday what needs to be done before November to get a deal. What's the process? What's left undone? I think Fatih Birol said it was halftime up till now, and now it's the second half, the next 6 weeks.
Yeah. Well, there is this high-level committee that has been established there, and behind the scene there are many of my colleagues have been meeting and discussing how to achieve the targets. Of course, one reason for a range is we still don't know how things will turn out in some of the countries that had disruptions, Libya, Nigeria, and of course Venezuela declined. So we want those countries also some clarity on where their production is going to be as we approach the meeting in November. The committee, with the help of the Secretary General and the President of OPEC, are having these dialogues. As I understand, there were some good meetings in Istanbul last week that brought us closer together. So the exact distribution and the exact cap will be worked between now and November. And I think equally important, non-OPEC is showing willingness to join in this effort. I will not mention names, but many countries have said they're willing to not only freeze, but cut at healthy levels that will match whatever is going to happen by OPEC. So I think the value proposition of an agreement is clear. For a small percentage of the total volume of these like-minded countries between OPEC and non-OPEC, we have the potential to get a significant improvement in market condition underpinned by healthy prices, less volatility, and clarity on the path forward that will also benefit companies around the world, whether they're producing companies, operators, but also the supply chain that has been hurt, also the financial industry, which is present in this conference, need to see the light at the end of the tunnel. And we want to say that we are exiting the tunnel. It's not a long tunnel ahead of us.
Thank you. I want to take one question from the audience, but before we do that, I think we need to ask about Aramco's transformation and what the company looks like when this whole process is over. I mean, when you were CEO, you had this ATP program, which was to sort of rethink Aramco. There was ambitions to make it the largest integrated energy company in the world. And now with this IPO, it will change again. Where is Aramco going to be when this process is over? What's it going to look like?
Well, the ATP is on its way of being implemented. We have members of our board here with us. They've been very supportive of the program. We're still going to reinforce our leadership in the upstream, double our gas production, improve the energy mix within the kingdom with more gas and utilities and industry. Saudi Aramco is on its way already of being the largest refiner to match our dominant position in the upstream. But we're also going to be a very large company in the chemicals space. Chemicals consume roughly 15% of the hydrocarbons produced globally, and Saudi Aramco needs to hedge its exposure to the markets by having a strong. It also adds a lot of value. So that's on its way. We acquired a 50% share in Lanxess, which is an elastomers and rubbers company here in Europe. And of course, Sadara, which is the world's largest petrochemical project, is starting up as we speak, and we have other projects that are under consideration. Part of the ATP was to leverage our capabilities for the benefit of the kingdom. That was before Vision 2030. That is going to basically be sort of turbocharged with Vision 2030 to make sure we meet the more ambitious expectations of the nation that have been launched with Vision 2030. I think the listing of Saudi Aramco is going to achieve a number of things. A, it is going to show what Saudi Aramco is to the broader global community. Everybody in this room knows what Saudi Aramco is. They're our partners across the industry. We work with them. They know that the company is one of the best and it's the pride of our industry. But the rest of the world, the financial community, the investors, don't know it. Once we disclose our financial statements, which we will proudly do once our government releases us to do that, they're going to see what an incredible company is in terms of its cost, profitability, and the strength of its balance sheet, and what it can do across all of the important performance indicators, and not just the financial ones, but also safety. The environmental performance of Saudi Aramco is first class in all aspects. So that's also going to allow the company to go global in the upstream if we choose to. If we have 5, 10%, whatever percentage we end up having that's listed over time, my prediction is over time our portfolio in the upstream will also match that ownership. So gas today is an interesting area for us to look at. Oil, less so, but in due course, as markets tighten and opportunities arise, I think the Saudi Aramco that is publicly listed is going to be welcomed and invited to participate in global projects in the upstream, and we will be doing it. Also, as we become clearly the largest downstream company in chemicals and refining and retail and marketing and lube oils and so forth, being listed and being transparent and having all of the disclosures that come with it is going to assure many markets around the world of who is this company that is in their street corner in the neighborhoods and and part of the fabrics of this economy. So I think it's going to be helpful. It's going, of course, to have its financial benefits to Saudi Arabia with the cash flow that is coming from the IPO. So I see it as a win-win-win for the global industry, for markets around the world that will be serving, for the Saudi people that will be able to buy into the company that has been the main driver of our Saudi economy, for our employees that will be seeing their company looked at as the #1 global company in terms of valuation, in terms of performance, and hopefully as we showcase what we can do and improve in areas that are important to populations like the environment and taking care of people, that it will be the most respected company in the world.
Yes, Philip Rose, Energy Intelligence. Can you say a word about Saudi Arabia's renewable energy plans and ambitions? Thank you.
I talked about gas. Of course, our energy mix today has a considerable gas portion. We're going to double our gas, and that will be significant. 70% of our utilities will be fueled by gas. We're introducing, as we speak, 10 gigawatts of solar and wind. That will be about 10% of peak consumption will be coming, and this is a 5-year plan. This is phase 1. As we gain experience and look at the cost competitiveness of renewables against gas, that will be increased. We will also be doing all of the preparatory steps to introduce nuclear. I think the decision that nuclear will play a part in our utilities has been made, but we are taking our time and doing it very deliberately to make sure that all of our regulatory steps have been done properly, and that we have both the international as well as the domestic regulations in place. We'll be selecting sites very soon that we will reserve for our first nuclear energy power plant, and we hope within the next 12 months that we will be announcing concrete plans with specific times. But for sure, wind and solar are going to play a very significant part of our energy mix, and I think importantly also, we're going to localize those industries. We're already talking to manufacturers of wind turbines to manufacture them in Saudi Arabia, and we're also on our way to bring in solar manufacturing across the value chain, from silica to thin film technologies, all the way to the services, installation, and the whole industry.
Okay, thank you. Well, we have to wrap it up there. Khalid, thank you for your time. Thank you for your thoughts. Please round of applause.